Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name's Patrick Denawilla. I'm the editor of the Chart Report, and I'll be your host. We've got a brilliant guest for you today. David Lundgren will be joining us to make sense of these markets. David is the founder and chief market strategist of MOTR Capital Management, a hedge fund that employs a technical and trend following strategy. Prior to launching MOTR, David was a portfolio manager at Wellington, which is a large Boston-based asset management firm. We share the same obsession with charts and technicals, so it'll be a good one as always. But before we talk to David, it's Friday, the markets are closed, so let's take a quick look at how this week played out. It was a short week with the holiday on Monday, but all four major indices closed higher. The Russell 2000 actually led, gaining more than 3%. This was its highest close in nearly 3 months, which is pretty constructive given how vulnerable it's been looking lately. It's continuing to hold that crucial 1700 level, so we're starting to see some participation from small caps slowly but surely. The NASDAQ actually lagged slightly, but it's still gained more than 1.5%. It closed higher for the 6th consecutive week, and it hasn't had a streak like that in almost 2 years. So it might have lagged a little this week, but nobody feels bad for the NASDAQ here. Taking a closer look at the S&P 500, it managed to close at a new 52-week high on a weekly basis, just 2 points above those August highs. Bulls want to see that level around 4,300 start acting as support in the near term. A failed breakdown here would be ugly, but so far so good. Overall, it was a pretty bullish week. You even had the VIX closing at 3-year lows, and it's below 15 for the first time in the post-COVID era. Now, taking a quick look at sector performance, all 11 sectors closed higher. Consumer discretionary led, gaining more than 3%. Meanwhile, defensive sectors like staples and utilities lagged, but still closed slightly higher on the week. Anyway, that's enough from me. Let's welcome David onto the show. All right, David, welcome onto the show, and thanks for joining us today.
Man, it's my pleasure. I've been looking forward to doing this with you for a while, so thanks for having me on. Hope we have a great conversation.
Yeah, I'm a big fan of your work, and we've been talking about doing this for almost a year now, so I'm glad we could make it happen.
Yeah.
But listen, before we talked about the current market environment, I want to introduce you to our audience a little bit and get a little bit more background on you for the people who don't know you already. So how'd you get into technicals in the first place? I know you've worked at big firms like Fidelity and Wellington in the past. So what kind of led you to looking at markets through technicals?
You know, it was luck, honestly. I knew the only thing I knew about technicals at the time I first actually learned about it was that it didn't work. And that was according to my professor in school. So, and we unfortunately, 30 some odd years later, we still have that problem with professors telling students that technicals and trend following and momentum doesn't work, which is a whole rabbit hole we can maybe get down later in our conversation. But nonetheless, my first job was a broker, actually up in Canada. And I just happened to be my desk was right next to this gentleman named Kuldeep Raheel, and he managed his entire book using technical analysis. And I had never really seen it put to work before. And you know, I just watched him put it to work and save clients a lot of money by managing risk properly and using the tools of technical analysis to vet the buy and sell recommendations of the firm. And it was, I just saw it come to life. And it was just one of those things where I think most technicians can say the same. Patrick, you're probably the same, that as soon as you learn about it, it just hits you and you're like, I don't know if there's a better way to invest in this. So I've literally been a technician ever since.
Oh, that's awesome.
Yeah.
Did you have any specific mentors or people that you really like their style kind of thing?
Yeah, I did. I had so that first job was up in Canada, and then I moved back to the States. I'm obviously from the States, from Boston, but my wife then and still is from Canada. And so I was up there for a period. And when I moved back, my first job was at a company called Technical Data in Boston. And my job there was to write technical buy and sell recommendations in the bond futures contract. And all of the clients were basically traders on the Chicago Board of Trade floor and various bond managers around the world, really. And when I was there, the two gentlemen that I would credit to this day as being the most important influences for me in the business is Jim Donnelly and Joel Marver. And they're like Jim Donnelly was to this day, I think he's like one of the best natural chart readers that I've ever known, in his ability to just identify the nuances of trend shifts and momentum changes and things like that. He was just so good at it. And Joel Marver is, to the extent that I've done things sort of down the beaten path outside of regular technicals, like, Drummond geometry or market profile or these other things, that's all from Joel. And to this day, those are very, very big parts of my process today.
Interesting. I'm not familiar with those two gentlemen.
Yeah.
But, as far as your process goes, you're pretty much 100% technicals, right? And specifically trend following. Is that correct?
Yeah. I mean, it's 100% technical. And I would say that in my earlier years, I was 100% technical just because I had disdain for fundamentals and fundamental analysts and everything else. But as I matured and came to look at things a little bit more open-mindedly, I just, and I think this has a lot to do with when I actually transitioned when I was a technical data, it was all focused on fixed income and commodities and things like that, futures. When I went to Fidelity, it was all equities. And so that transition to equities really opened my eyes to fundamentals. And, I have slides in here that we can talk about. We can go to them whenever you want, but the simple truth of the matter is that over time, what affects a stock's price is the underlying fundamentals. So if you ask me, even though I'm a pure trend following technician, momentum investor, if you ask me what's more important, fundamental trends or price trends, I would say hands down, fundamental trends are way more important, because without strong fundamental trends, there are no price trends. So it's not that I don't believe in fundamentals. There's nobody in the world that believes in fundamentals more than me. It's just that I happen to think the market's the best fundamental analyst on the planet. And
I love that.
It's so hard to beat. That's why it's so hard to beat. And so it's just like, I can show you a slide on this. So this chart shows you over short periods of time, almost half of what happens to a stock is based on valuation, expansion, and contraction. But as you get out to 3, 5, and 10 years, valuation drops to 5%. And that means that 95% of it is fundamentals and 75% of it is top line revenue growth. And this is why William O'Neill, rest in peace, legend in the business, huge influence in my life. But this is why William O'Neill smartly, if that's a word, migrated to top line revenue growth as a place to really look for those right tail events, those real true market leaders, as he used to call them. And this is why. This is proof positive as to why. So it's not that fundamentals don't matter. They matter more than anything. It's just that if you look at this next slide, unfortunately, those that use fundamental analysis and everything they learn in graduate school and everything else to try to beat the market, they don't. They don't beat the market. 88% of them underperform the market. So my simple question is like, if this is true, this is undeniable evidential proof here. If it's true, then when do we as investors admit that the market knows more than we do? And when do we just say, okay, I know a lot, but the market probably knows everything I know, and it knows everything I know that I don't know. But most importantly, it knows all the things that I don't even know I don't know. And this is why I underperform, right? So when do we say that? And it's not like we're stupid. I've worked with some of the smartest people in the business over the years. So it's not that it's a smarts thing. It's just it's a disadvantage, a competitive disadvantage based on the lack of information that we have, despite thinking we have all the information. We don't. So when do we just admit that and say, well, how do we fill that hole? Well, we can fill that hole using technicals. Right? So keep your process, do whatever you do as a fundamental investor, but wait for the market to agree with you. Well, how do I know that? Trend, momentum, right? So that's it. And so I think this is evidence enough to say that we should probably listen to the market more than we do and give it a lot more credit than we do.
Yeah, I love what you said there. The market is the best fundamental analyst out there. Because I've always thought that whole debate between technicals and fundamentals is kind of silly. I mean, of course, fundamentals matter. It's just that for technicians, we prefer to look at or interpret the fundamentals through price action, right?
Exactly right.
So I want to ask you about your hedge fund. I know you can't talk specific positions or performance, but as far as the strategy goes, you're basically executing a model. Is that right? How much discretion is involved, and what exactly is the methodology?
Yeah, so I've like as I said earlier, I've been a pure trend following tech momentum type investor my entire career, and what I've come to appreciate is that when you're in a bull market, systematic momentum, systematic trend following is extremely difficult to beat. So when I can identify the regime as being we're in a bull market, that's when I become very systematic. And the analogy I use is a pilot on a plane. And when we're in a bull market, I take my hands off the controls and I just let the plane fly. But when we fly into a flock of seagulls, there is no autopilot solution to that. So you have to put your hands on the controls and fly the plane until things normalize again. And the reason I do that is because as strong and effective and I would say unbeatable as systematic momentum is in a bull market, it does not do well in a bear market. In fact, in some cycles and parts of a bull market, it can literally get its face ripped off. So in those moments, for those reasons, I focus on two things. Like the name of my company is MOTR, which stands for momentum and trend. And so in a bull market, I focus on momentum. I use trend all the time, but I focus primarily or lean on momentum more in a bull market. So that's my primary input. And then I size my positions according to volatility. And I don't lean on stops as much because stops can actually hurt you in a bull market. And then when you're in a bear market, I'm always using momentum, but in a bear market, I lean more heavily on trend. And instead of sizing my positions according to volatility, I size them according to this concept of value at risk, which is just, if I'm wrong on this stock, I'm willing to lose 10 or 15 basis points in every trade. And so the whole idea is that recognizing that you're in a bear market, knowing that most things you do are going to be wrong, you should be risking a lot less, but you should always be executing your process. So when you see a setup that meets all your criteria, even if it's a bear market, you have to take it. But just take it smaller because you know there's a high odds of failure in that instance. And then watch, rinse, repeat until you get to a bull market.
Yeah, and I like that emphasis on, making the distinction between what sort of environment we're in. Are we in a bullish environment or a bearish environment?
Right.
And on that topic, I keep hearing that this is a very challenging environment for trend following. And I'm wondering what you think of that.
Yeah, no, I've actually heard that debate, but certainly discussion quite a bit lately, and it frustrates me a little bit because when if you ask me, trend following is working perfectly, and the reason I say that is because when we define what trend following is specifically, like holistically, what is it? Trend following momentum is a strategy that gets you into the best stocks in the market during a bull market. That's part one. And then part two, the part that everybody's missing and ignoring, is that the other half of trend following is that it saves your bacon in a bear market. So just because trends aren't really unfolding the way you would like them to unfold, that doesn't mean trend following is not working. It just means half of trend following is not working. The other half, which is the one that helps you dig small holes when the market's not working, is working perfectly right now. So like last year, I had a very low drawdown relative to the S&P because of trend following, not because trend following was broken and therefore I had a drawdown. It was the process worked perfectly. It saved my bacon. And so now when the bull market resumes, I'll have a small hole to dig out of, and I'll concentrate the portfolio on as Bill O'Neill would call them true market leaders, and away we go,
Now, is the fund long only, or do you have shorts in there too? Like last
short.
year?
Yeah.
Did you put it? Okay.
It's long short, but I'm very explicit about this part of the process because we know that there aren't any long-term successful shorting investors in the business. I mean, there are some that do really well in certain environments, but by and large, shorting the equities is not a good idea. But sometimes it's really a valuable tool either to make money or to literally hedge. So when I can identify a regime that's not a bull market, that's when I'll engage on short exposure. But when my regime model inflects to bull market, I'll cover all my shorts because there's no sense in wasting my time shorting. So I have shorts on right now, although it seems kind of strange that I would be, given what the S&P appears to be doing so far year to date. But beneath the surface, as you've talked about a lot and others have talked about a lot, there's a lot of damage going on. And still to this moment, there's still a lot of damage going on beneath the surface that doesn't get recognized because of what's happening with these mega cap names that are just kind of like masking everything over.
Yeah, and we'll talk about breadth in a second, but you gave an awesome presentation in San Francisco about a year ago where you went into detail about your process, and you showed a couple of visuals that really resonated with me, and I asked you to bring them along today. And one of those was kind of inspired by Charles Dow's work, who founder of the Wall Street Journal. He's known as the grandfather of technical analysis. And one of his big tenets was this idea that trends occur at any given time. There's trends in multiple time frames, these different time frame trends. You have the primary trend, the secondary trend, and I think he called it the minor trend, right? The kind of day-to-day movements, right. Whereas the primary trend is that long-term trend. And you kind of had your modern take on it in your risk gauge here. And you compared it to the ocean, right? There's the wave, the tide, the ripple, and the spray, right? So break it down for us. Explain this risk gauge a little more.
Yeah, thanks. I will, and I appreciate you highlighting that this is not a unique concept. This is as old as it's over 100 years old. Charles Dow came up with this concept of this notion that price trends unfold in different directions at various points in time. Sometimes they're all moving in the same direction, but other times you'll have like last year we had a primary downtrend, but we had a massive daily time frame uptrend. So that was the ripple in the spray going against the tide, right? And so that was an incredible observation over 100 years ago from Charles Dow. And so what I've done is, so the risk gauge is based on 5 inputs, and they're measured across 4 timeframes. And so, Patrick, you probably remember this risk gauge from when I was out in San Francisco, and it used to say tide, wave, ripple, and spray. And people asked me too many questions about it, so I got caught up in it too much. So I just changed it to what
I know. I loved that. You simplified it.
Yeah, I know. So I think you and I were the only two that understood it, so I had to change it. But so it is what it is. It's quarterly time frame, monthly time frame, weekly, and daily. That's essentially what he was capturing. And the way that my mind works as it relates to the market is very similar to Charles Dow. He would say that everything's in price, and so in this model is the different ways you can measure what price is doing, and that's it. So in other words, in this model, I don't have valuation, I don't have how steep the yield curve is, I don't have seasonals, sentiment, flows, positioning, any of that, because none of that has to align a certain way in order for a bull market to happen. So I have this concept of inviolable rules of trend following, and the idea is that if you can identify things that must happen for a bull market to unfold, then you're in a good spot, because until those things happen, there can be no bull market. And so this whole entire risk gauge is built on concepts like that across 5 different inputs. So the inputs are price trend, relative price trend, cross-sectional momentum, which is just a fancy way of saying something that technicians have been calling momentum for over 100 years, and then breadth in volatility. So if it's not one of those 5 things, it's not in this model. Not because I don't care about it. I monitor all those other things, but they're not in this model because, as a good example, like last year, Patrick, last year, the sentiment was really bearish. Like in some cases last year was record levels of bearishness, but the market just kept going down anyway. So it's not inviolable. It's not like every time the level of bearishness gets to this level, you are guaranteed a bull market. So because you can't rely on it like that, I'm aware of it. It lets me understand what's going on in the background of these indicators of this risk gauge, but I don't act on it. So a simple example of it would be like price trend is something like, if a stock is at $10 and you think it can go to 50, I can guarantee you, 100% guarantee you, there are no guarantees in this business except for this one, that it cannot get to 50 unless it goes past 11 first. Right? Finding a way for that to happen. You can't, right? So all of the concepts that are in this risk gauge are like that. So when I look at the risk gauge today across 4 timeframes, you see just a mess, and you actually see that, which is really surprising. You see this quarterly time frame is down at 7. So remember, the quarterly time frame is like if you get a correction out of risk on into mixed, because it's the quarterly chart, that means you could be getting 20, 30, 40% corrections. And you can see that down here at 7, which means that you're in a really deep cyclical bear market. So if quarterly time frame goes into risk off, that's like a global financial crisis type of bear market. So you can see here how close the breadth of the market is hinging on a GFC type event. That's the last time that this model was down in the risk off on the quarterly. So you can see this, like this is just not the makings of a bull market. So the issue though is you have, if I can show you another chart here that I featured in my research not too long ago. So this red line is the average stock. It's the value line geometric average. It's the average stock, right? It's what's happening on average. And so you can see that it's a massive cyclical bear market. You take out this low and that risk gauge, it might even happen beforehand, but should it happen? If you do go below this low on the value line average, you can rest assured that the risk gauge on the quarterly time frame will probably go into risk off, which would be like an Armageddon type bear market. I'm not saying that's going to happen, but I'm just pointing out that that's how close we're sitting on, right? But
right.
Here's the issue. We all know the market bottomed in October. The average stock bottomed. This index here is what I refer to as the management index, which is just an acronym for the 9 stocks that are carrying the weight of the market today. So it's, you can see it down here. It's Microsoft, Apple, Amazon, Netflix, AMD, Google, Meta, Nvidia, and Tesla, right? Put those together.
I think that probably does, that group of stocks, it represents it a lot better than FANG. That's an old acronym at this point. Maybe they were moving together back in whatever it was, 2016 or something. Right. But, now you have names like NVIDIA and Tesla in there as well. So I think that probably does it justice. And I love this one. So go ahead, keep going.
Yeah, but the point is that because I don't know what the number is today, but when I last looked at it, it was 80% of what was happening to the S&P year to date was driven by these 9 stocks.
More than 80.
When you actually look at it like this, where my cursor is here, that's where the market started the year. And I think as of today, I think this average is actually down year to date. So the average stock.
So you're saying basically the average or median stock hasn't made any progress this year.
Well, slightly
Again,
down.
Different way of looking at the fact that a lot of the gains this year are being driven by just a few names.
Right. And this is causing a lot of debate and conundrum that people are really having a difficult time deciding what to do. And so like especially if you're a hedge fund and you're just really, truly, you're just listening to the market, what's your job? Well, your job is to do 2 things. It's to find uptrends that are outperforming and downtrends that are underperforming. That's it. And if you have them, do them. And it just so happens that right now you have them both. So that's it. And so if you look at this other slide here, the last time we had such a disconnect of this magnitude was actually back in 1998. So this, again, these are similar charts. This is the value line average, the same exact chart as the prior slide. But instead of this being the management index, this is the NASDAQ 100. And back then they referred to it as the new economy. So this was all the .com stocks that were going to put out of business all those old economy stocks, right? And that was represented by this red line, the average stock. And that divergence, this is the important part, that divergence actually started in 1998. So it was, yes, unsustainable, but it wasn't something that stopped the market from going higher or going into a bubble. In fact, you could even say it was part and parcel with the bubble. And so the idea back then, if you would have just listened to the market, the idea back then was to be long what's working and be short what's not working if it's in a downtrend. And that was the way to play it in the last massive bifurcation that we had. And I'm arguing that until things change, that's how you should be doing it today. So you should be long all these things that are AI related, and I call them toothpaste tech, which is basically tech companies that have recurring revenue streams, and it's like toothpaste, right? So you go into a recession, you're not going to stop brushing your teeth, I hope.
Right.
Certainly not stop drinking. So Budweiser, right? But today they kind of view like all these SaaS companies as being recurring revenue because of subscription-based models, and so you're not likely to cancel them in a recession. So these things are very resilient cash flows. So they're doing extremely well in this environment. Then you throw in the kicker of the reality that they're also leading the charge on AI, you could have something like this, a pretty spectacular bull market in those stocks, while everything else that's doesn't have recurring revenue streams, that's not tied to AI, in fact, is going to get put out of business because of AI, which was the old economy risk back then. You could just see it play out again. And what you should have done then was be long what's working and be short what's not. And that's it.
Yeah, and I'm so glad you brought up AI here, because I wanted to ask you about it from kind of a behavioral or speculative kind of point of view. It definitely seems like it's the new hot investing theme. And we've seen this story before with 3D printing stocks or electric vehicle stocks or pot stocks or blockchain stocks, you name it. And we know how that story tends to end. You know, you get this massive run up and then this bubble popping, and it's painful. So do you think AI is a bubble? And do you think what kind of stages are we in for it?
So I'll say two things to start. I think it's risky to label anything, because labeling something gets your mind to go down a rabbit hole that maybe it doesn't belong down, right? Because, you know, if you say bubble, by definition, you're not going to want to do it, because who wants to invest in a bubble?
Right. It's the same as labeling something a bull market or a bear market. It's the trend higher or lower. That's probably a better way to phrase it, right?
Yeah, and you know, and especially if you label it a bubble and you steer everybody away from it, now you tell everybody that now you're never going to participate, because now you've behaviorally tied yourself to that expectation and that definition.
Right. It's like that quote, you know, a bubble is whatever you don't own, kind of thing, right? I'm totally butchering the quote, but you know what I'm saying.
Yeah. But when I was at Wellington, I had the incredible fortune of working with Frank Texero, who I'm pretty sure I know you know him. He's one of the best technicians in the business. He's one of the best that I put him up there with William O'Neill and whatnot. And
just a fun guy too. He's great.
Oh, he's incredible. We just had a blast every day at work. People would see him at the CMT symposiums, and he'd just be like off the cuff, you know, being frank, and people would come up to me and say, "Is he like that all the time?" I'm like, "Yeah, it's like that all the time." but at any rate, he just so you know, in 1999 he was up 500%.
Wow!
Because he didn't necessarily label it as a bubble, but he saw what it was, which is trending and outperforming. Why?
And this is at Wellington. He was up 500% in that fund.
Yeah.
In 99.
Then the next year he was up 25% because he got stopped out of everything. So when the market rolled over, he was up 25%. But that was just him doing his job. And he'll tell you this. It was him doing his job. It's not because he identified the bubble and made this great call. He just identified what was and stopped asking questions. The only question he asked was like, where should I put my stop? And that's the only question you should ever be asking. So when he retired or withdrew from the partnership at Wellington, he made this, withdrawal speech, which you give when you're withdrawing from the partnership. And one of the things he said was he was praying for another bubble. Please, God, give me one more bubble. Because the thing is don't be afraid of bubbles. I mean, I'm praying that this is a bubble. Trust me, I'm praying this is a bubble, because that means this is going to happen again, right? So I'd rather not label it as a bubble, because it just prevents you from engaging with it when you should. And then the other thing I would say is one of the ingredients to a bubble is the inability to fundamentally really truly identify what the heck is going on. That's why Bitcoin did what it did. That's why Tesla did what it did, because there was you could drive a Mack truck through the estimates on Tesla, or a Mack truck through the opinions of whether or not Bitcoin is real or not. And these are, like as I said earlier, these are smart, way smarter than me, fundamentally oriented investors coming to well-reasoned conclusions that were way different from each other. When you have those conditions, that's when you get bubbles. Because if you can't really pin it down and say, this is precisely what's happening, your imagination runs wild. And then that's what happens. And I think AI has the potential to do that. I mean, I think there's a lot of similarity between this and the dot-com bubble.
Wow, I think that was a fantastic answer. And I appreciate that story from Frank too. I think it kind of reminded me of that point you made earlier, right? If a stock's going to go from 30 to 50, what has to happen first, right? The trend has to turn higher, or at least price has to get above some sort of moving average or something like that. And then from there, yeah, it might go modestly higher, or it might rip, it might go parabolic like the NASDAQ in 1999 or something like that. And as long as you have some sort of risk management, whether that's a moving average or whatever it is, it'll take you out before the trend really goes against you.
Which is evidenced by the fact that he was up 25% in 2000.
Wow.
Because if you remember, 2000 started as like the final throes of that bubble, and then it all rolled over. So he made a lot of money in the very beginning of the year, and then got stopped out at a 25% profit as the market melted down. But what is interesting about that meltdown is that when the market finally peaked in 2000, the average stock bottomed. So while from 1998 to 2000, as you can see on this chart, there was actually a stealth bear market. Like there was actually, this was easily the worst bear market since the 1970s beneath the surface, if it wasn't the worst bear market since the 1930s. So we referred to it back then as a stealth bear market. And then
right, and it was seductive too. I mean, you had multiple double-digit rallies along the way. I mean, over 15 double-digit rallies, I think, on the way down. So there was numerous chances where you thought that was it, we're going up, new bull market kind of thing. And I can't imagine trading through that period.
Yeah, it's never easy, but we can complicate it by asking. Like I always say, like if you find yourself asking yourself questions, just be mindful of what the questions are, and just as soon as you ask yourself a question, stop and ask yourself, is this really truly answerable? And you'll find that 99.9% of the questions you ask yourself are not answerable. And so therefore, why would you try to answer them? Just do your job, which is find things that are trending and outperforming and place your stop, wash, rinse, repeat. And
I love that.
At the end of the day, you'll get all the answers to the questions you have later. And I always find, like, if you can answer questions at the time of trend change, the trend's probably not going to work. So like when energy inflected in I think it was in 2003, when energy inflected higher, that was after one of the biggest bear markets we had seen in history. EM had blown up, and all these different frauds had come to surface and come to light. And so when the market finally bottomed in 2002 and then 2003, if you're just doing your job, the market's trying to get you to buy some of the riskiest assets in the market. And you're like, are you crazy? Did you see what just happened? And you want me to do what? You want to buy emerging markets and energy? Are you out of your mind? And that ended up being the leadership for the next 10 years. And 10 years later, we understand why.
Yeah, I mean, it makes a lot of sense that you're a trend follower. Seeing what you saw at Wellington in the early 2000s, late 90s. I mean, that it makes a lot of sense.
Yeah. It's just try not to ask. Don't overcomplicate questions. The questions you should be asking are simple. Is it in an uptrend? Is it outperforming? Where's my stop?
Right.
And maybe if I was to throw another question, it would be, what kind of a regime are we in? Because the regime question only tells you how much you should be risking. So like right now, if you look at all the breakouts that have happened on the weekly chart, on the up to the upside, about half of them are actually in the money since they broke out. So what should your expectations be right now? You should expect most of the things that you buy that are breaking out are going to fail. That should be your expectation, right? So when it like trend following is not working, whatever you want to say about that, if it fails, that's your expectation. So if that's what your expectation is, well, maybe you shouldn't be risking a lot per trade. And then the corollary to that is that looking at that same trend model of the stocks that are broken down into a downtrend, 95% of them have actually gone lower since they broke down. That's not a bull market. In a bull market, when a stock breaks down, it traps everybody and takes off again. Right now, we have the opposite. We have it breaking out, trapping everybody and failing.
Yeah, there sure have been a lot of failed breakouts.
Yeah.
Challenging environment.
You have to keep doing it. The only way you protect yourself from the possibility, and I would say in this case today, call it likelihood that it's going to fail, is just risk less. And then when the regime switches, what I'm doing right now, I'm really focused on right now owning what I want to own when the regime indicator inflects positive. Because all I have to do then is just gross up my long book and cover my shorts if I haven't already. So I already own what I want to own for the next bull cycle because the market's telling me to own it right now. And obviously by that, I don't mean like, you can say like some staples are outperforming and maybe some utilities are outperforming. I don't own that stuff because they're outperforming because we're in a bear market. So they're not outperforming for the right reason. I own things that are trending and outperforming in the throes of a bear market. Like, that's kind of weird. So maybe that's the market trying to tell me what to own right now for the next bull market. So that's what I try to populate the portfolio with, without making any calls or forecasts or anything. And then when the regime indicator inflects, all I have to do is gross up the book.
Yeah, and that's kind of a point that Jerry Parker, who's another great trend follower who I know you've interviewed as well, when he was on the show, he kind of reiterated that point as well. Like, you got to take the trade, right? If your system is telling you, giving you a signal, you got to take the trade. It might fail. There's a good probability it might, but you have to take it when you get that signal. Is that kind of along the lines of what you're saying?
In the psychological effect of it, which is what makes it so hard to do this, is it like if you're having difficulty executing your strategy, it's because there's a disconnect between your expectations and what the market's trying to tell you. So you're not listening to the market. So the market's telling you that, and it's not like this is like a secret. All you have to do is do the analysis, and the market's telling you that half of the breakouts have failed. So if you want to fight that, go ahead, maximize your gross long exposure and get long out the eyeballs in an environment where half the market's failing on breakout. And so if you're listening to the market, you should be always executing. But the reason mentally you can execute now is because if you're listening to the market, you've been doing it on a small scale, so you're not all beat up mentally. And then the corollary to that is that when we do get into a bull market and every single breakout on the planet works, now we think we're a genius. And I'm not making money because of trend following. I'm making money because of me. I'm smart. And the unfortunate truth is that that's never true. The reality is we're never as stupid as we think we are, and we are never as smart as we think we are. We're just fortunate to have a good strategy to navigate us through it all.
Well, you know what they say, don't confuse brains with a bull market, right? Well, David, we got to wrap it up, but before I let you go, where can our viewers find more of your work if they're interested? Okay,
yeah, thanks, Patrick. So you can follow me on Twitter, dlundgren3333. You can find me on LinkedIn, and you can also go to my website, which is you can see it spelled down here. It's MOTR, which is Momentum and Trend. So it's motor, cmr.com. And on that site, you can actually sign up for my, it's called the Charting My Interruption, which is it's a note that I send out every Friday. It's for free, and it just talks about stuff like this on a weekly basis.
Yeah, that management chart came from Charting My Interruptions. Right. I really like that column or blog, whatever you want to call it. Yeah, it's very interesting. And to our viewers, definitely go check it out. It's free. But David, thank you so much for coming on and sharing all your wisdom.
Absolutely, Patrick. Thanks for having me on.
Of course. Have a great weekend.
You too.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week.